When considering investment options for young people, the goal should generally be long-term growth with relatively low risk while setting the stage for financial independence. 1. Index funds and ETFs, exchange-traded funds. Why? These are low-cost investment vehicles that track the performance of broad market indexes, such as the S&P 500. Why it's good for young investors. Low fees. Index funds generally have lower fees than actively managed funds. Diversification. With one investment, you get exposure to hundreds or thousands of companies, which reduces risk. Long-term growth. Historically, stock markets have grown over the long term, making them ideal for a young investor's horizon. 2. Robo-advisors. Why? Robo-advisors are automated platforms that create and manage an investment portfolio for you. Why it's good for young investors. Hands-off. Perfect for those who don't want to actively manage their investments. Low minimums. Many robo-advisors have low minimum investment requirements. Diversification. They usually invest in a variety of index funds or ETFs across different asset classes, stocks, bonds, etc. 3. Individual retirement accounts, IRAs. Why? IRAs are tax-advantaged accounts that allow you to save for retirement. Why it's good for young investors. Tax benefits. Contributions may be tax-deductible, traditional IRA, or grow tax-free, Roth IRA. Long-term focus. If you're young, you have decades for your investments to grow and benefit from compounding interest. Flexibility. You can invest in stocks, bonds, and even real estate via IRAs. 4. High-yield savings accounts or certificates of deposit, CDs. Why? These are safer, more liquid options compared to stocks, where your money grows with interest. Why it's good for young investors. Safety. These are low-risk, FDIC-insured accounts. Liquidity. You can access your funds